Good afternoon, good evening, and good morning to all of you. I wish to welcome all of you to our webinar. It's a real pleasure for us to have you join us. Over 900 people from around the world registered for this event, and I see now that there's now almost 200 people on the platform. So that's really great to have you, and I hope we can have a really good exchange. Let me introduce myself and our panel members. So first of all, my name is Marisol Estrella. I work with the UN Environment Program at the Crisis Management Branch based in Geneva. I'm also the coordinator of a collaboration that we have between UNEP and the government of Norway's Oil for Development program. This collaboration that we have with Norway seeks to strengthen national capacities to enhance environmental governance and environmental management in the oil and gas sector of selected countries in Africa, Asia, and Latin America, including Colombia. And so we are, in fact, have been working for the last 4 years together with Norway in ensuring that we can deliver and make more accessible environmental best practice and reduce environmental and climate risks associated with oil and gas development. And so one of the sort of services that we would like to provide is really to enhance knowledge and disseminate best practice. And so this webinar is in fact the first of a series of webinars on enabling oil and gas producing countries to transition towards a low carbon future. As we know that we are moving towards a global energy transition under the climate change agenda. And so it is really important then for us to have this dialogue with especially oil and gas producing countries on future scenarios and what are the best ways to effectively manage potential risks associated with oil and gas development within this future scenario. So it really is a great pleasure for me to welcome our panelists. I would like to thank our co-organizers for the webinar. So this includes, of course, the Government of Norway, Chatham House, specifically the New Producers Group, and also then the Natural Resource Governance Institute, who has also been part of organizing this particular webinar. So again, welcome to all of you to our webinar. Let me introduce now our panel speakers. First but not least, our moderator, Dr. Valerie Marcel, who is a fellow at the Chatham House. Valerie has been a project lead of the New Producers Group and has facilitated a South-South knowledge sharing network of 30 emerging oil and gas producer countries. She has expertise on national oil companies, petroleum sector governance, and emerging strategic issues shaping the energy sector. So welcome, Valerie, and thank you for moderating this session. Let me now introduce our speakers. Ms. Gleda Laan is a Senior Research Fellow with the Energy, Environment and Resources Department at Chatham House, based in London. She has 17 years experience in international resource governance and energy policy. She has a background in oil and gas governance issues, and looking at the nexus between fuel, energy, water, and environment linkages. So welcome, Gleda. I would like to then introduce Mr. Espen Andreas Hage. I don't know if I'm pronouncing your last name correctly, who is a petroleum economist at the Norwegian Petroleum Directorate. Espen currently works on revenue projections from petroleum activities on the Norwegian continental shelf and resource assessments. He previously served with the Norwegian Ministry of Petroleum and Energy and the Ministry of Foreign Affairs. So it will be really a welcome to have Espen share the experience from Norway. Next is Mr. Diego Grajales Campos, who is the climate change coordinator at the Ministry of Mines and Energy in the government of Colombia. Diego is an environmental engineer specialized in energy management with experience in research, analysis, and evaluation of environmental issues, climate change, and energy systems. And so he is currently coordinating the implementation of the comprehensive climate change management plan and the 2050 carbon neutrality vision of the mining and energy sector in Colombia. So welcome, Diego. It's a real pleasure to also have another country level perspective and experience. Thank you. And then last but not least, Patrick Heller, who is an advisor at the Natural Resource Governance Institute. We have worked with Patrick also in past workshops, so it's really welcome to have Patrick again. He is a fellow at the Center on Law, Energy, and Environment at the University of California, based in Berkeley. His work focuses on helping oil and mineral-rich countries navigate the global energy transition and the governance of state-owned oil and mining companies, and the analysis of extractive industry legislation and contracts. So welcome, Patrick. So again, a warm welcome to all of the panel members. I just wish to kind of go over a bit of logistics. I want to remind our audience and our panel members that this is a recorded webinar. So it's a way for us to also capture and further share this discussion. It will be put on our YouTube channel shortly after the webinar. And let me remind our participants of the webinar. I see now that we have over 200 people on our platform, so welcome again. And on your dashboard, there should be a section on questions. Okay, so there should be. You will not be able to take the floor and speak. However, you'll be able to type in your questions in the question log. If you need to reach any of us, you're welcome to type your message on the chat box where you can send a message to the organizers. Okay, but if you have questions as you listen to our speakers, you can post your questions in the questions box. Okay. So without further ado, I will then turn to Valerie Marcel.
Thanks very much, Marisol. And I want to welcome you all to this first webinar in the series. I'm delighted to have the opportunity to chair this first kickoff webinar in the new series on the transition and oil and gas countries. I wanted to just give you a little bit more of a background to our approach to this panel. Patrick and Gleda and myself are part of the New Producers Group. And as Marisol explained, it's a peer-to-peer network of governments and NOCs from 30 emerging oil and gas producer countries. And so it's really based on knowledge sharing across this network. And the aim is to help emerging producers manage their oil and gas resources more effectively, but also to plan for the world beyond oil and gas. But we also are fortunate to have the inputs from Espen and Diego, who are from Colombia and Norway, two mature producers. So I think it'll give a really interesting opportunity for contrast and sort of teasing out the differences between different producers and how the kinds of challenges and vulnerabilities that they face in this energy transition. So the focus of the panel is indeed on how oil and gas producer governments and their NOCs can manage this transition. And so I think it's important to recognize that many of these governments have been expecting or the oil and gas sector to make substantial contributions to their economies through jobs and the creation of supply chains, local content, revenues, of course. But they're not all equally vulnerable or not vulnerable in the same way. But nevertheless, across the board, producers need to do some course correction at this stage, because we know that the world is changing. The move towards decarbonization will affect oil and gas producer countries, whether emerging or established in oil or in gas or a combination of the two. So I think we'll talk a bit about some of the tools that government can use to help them navigate these changes. And it'd be important for them not to make the wrong bets, you know, so that their economies are competitive in the next phase that's coming. So one key tool is a robust risk management system, because it helps petroleum agencies, NOCs, ministries of finance, see the risks ahead for their oil and gas sector, anticipate climate risks, and adapt their policies. We're also going to look at intragovernmental coordination. So a common obstacle to adaptation at the national level is that climate policy is not coordinated with the petroleum sector and vice versa. So for example, thinking about, you know, if you build a refinery, how this affects your country's commitment to reducing global greenhouse gas emissions. How a more integrated policy would have, you know, And so basically, I think that, you know, it's essential to have this integrated approach across government so that you're thinking, you know, how do the licensing plans affect your climate targets? How should the role of the NOC evolve within the context of those other climate targets? And similarly, petroleum sector ambitions and climate commitments aren't always coordinated with energy access objectives or fiscal planning. So, you know, you realize that there's actually quite a lot to juggle in terms of policy and planning. And you would like to have your petroleum and climate officials contributing, for example, to your integrated energy plan, where, you know, the country would think ahead about how much oil and gas should be exported versus how much should be used domestically. You'd want to think about, you know, what is your energy mix going to look like? What should it look like in 10 years, 20 years, 30 years? And how dependent do you want to be on oil and gas? So we're going to address a number of these questions through our panel. And first, I'm going to ask the panelists to respond to some first questions just to get us started and thinking around these issues. And Gleda, I'd like to start with you. First, to break down a little bit these differences that I mentioned between emerging and established producers. So countries, oil and gas countries that are at different stages of development of their sector will have different opportunities and challenges when they want to develop policies that would allow them to benefit from their oil and gas resources while preparing for the transition. So what specific issues should be considered when you're thinking of the development paths for emerging producers versus established producers? And also, what are the differences between oil versus gas?
Thanks very much, Valerie, for that question, and delighted to be here with our friends from UNEP again. So I think maybe we take a step back and we think about the concept of oil and gas in development. You know, there has been a lot of thinking about this over the years, and thinking has certainly shifted over the last decade. So I thought it was worth just thinking of the economic linkages that countries expect the sector to have with the rest of the economy, and that's, you know, essentially linking in two ways. Firstly, through revenues from the sector to government, so the investment revenues initially that fossil fuel projects generate. That's including the kind of signature bonuses, royalties, taxes, and the fees paid by the investing companies, and then the income from the sales themselves. So the second is the use of the oil and gas in the economy, whereby the government's share of production or buybacks from a producer company are actually, you know, consumed within the country. And in those terms, a lot of countries expect to develop industries and jobs around the sector, including in petrochemicals, fertilizers, as well as obviously, and you mentioned the energy access question, use some of the production in to boost the power sector, to potentially widen the grid and maybe produce refined products as well for transport. So that's been the traditional thinking, and the thinking has been to strengthen the linkages as much as possible, whereby the revenues will go into supporting and funding further development in the country and encouraging businesses to come in, and the fuels themselves will be used to boost the economy, and sometimes that means that they're sold at very cheap prices. So decarbonisation and energy transition, how does this challenge that thinking? Well, I think it challenges it challenges those linkages in a number of ways. So on the first point, investment options are for the sector itself are likely to decline. There's changing investment approaches and conditions from the MDBs. You can see that with their policies changing on fossil fuels in general, and other IFIs as well. They're increasingly trying to reshuffle their portfolio, shifting towards renewable energy, efficiency, climate resilient infrastructure, and pulling money out essentially of their more traditional areas of upstream, midstream, and power sector in thermal investment in oil and gas related infrastructure. I mean, secondly, on that front, you've got a change within the international oil companies. So there's 16 of the largest 20 companies that have committed to reducing their emissions, and I think 3 of them are going carbon neutral or nearly carbon neutral according to their commitments by the 2050s. It's not just the IOCs. I mean, PetroChina has also announced plans to invest about $1.5 billion in low carbon emissions projects to 2025. And there's a question about what those commitments and what those new budgets mean for the conditions that those companies put on their portfolio and which projects and assets they decide to divest from. You've then got a growing demand globally for low carbon oil, which will come about through a variety of measures, policies, and carbon taxes and border tax adjustments. So you're likely to see, the traded price of oil include that. So as you have today, the higher sulfur, the lower value the product, then the higher carbon intensity, products will be, then the lower their value may be in future. So there'll be like a premium on the lower carbon products. So that's another consideration for producers overall. And the final thing I wanted to mention, in terms of considerations that apply across the board, but especially to emerging and prospective producers, is the timeline. The timeline, essentially oil and gas were often conceived of as a resource to help a country make a leap to a more developed state and then to diversification as those resources depleted. But the timeline for that diversification appears to be shortening due to both the needed policies to meet that 1.5 degree or near 1.5 degree target that the Paris Agreement has set, and also the rise of alternative technologies and the rate of deployment of those technologies. So many people believe that oil demand has already peaked, and then for gas, there may be a window of growth, but probably only to the mid-2030s. So I guess like of overarching significance here is because of a number of factors, because climate change itself, and because of climate change actually already taking place, and you've got degrading environments, and you've got this industrial paradigm shift that's taking place. New producers may find themselves in a very different world in terms of the value of what they class as their resources and the prospects of developing different sectors and industries. So, for example, those producers who emerged in the 1950s and 60s, like the Gulf producers, Trinidad and Tobago, Netherlands,
diversification into petrochemicals, fertilizers, maybe aviation, and creating those strong linkages with the domestic economy and the oil and gas sector appeared to make sense. But now we've, in this age, the post-Paris era, if you like, new entrants are facing an industrial paradigm shift, which demands clean technologies, circular economy, automation and AI, sustainable agriculture and biomimicry, for example. Demands understanding those growing areas of industry. So I think, if you combine that with what's happening with climate change, the value of other resources such as food, fresh water, biodiverse ocean and landscapes, they also need to be considered in this mix alongside the trade-offs that development of the oil and gas sector would have. So just to mention, in terms of the different types of producers, I have over the last few years talked a lot about the Gulf producers, the producers in the GCC like Saudi and the UAE. They have a very different context to some of you guys in the room and your country needs and opportunities. So for the established producers, where there's already, for instance, very high dependence. In Saudi Arabia, about 70% of government revenue comes from oil. They both want to, and they're a country with a large reserve that could go on for decades. They're looking to secure their market share. They're looking to diversify into lower carbon fuels. Putting a lot of effort into new technologies like CCS and hydrogen, for example, and trying to diversify their economy as a whole and move into using a lot more renewables to constrain their domestic use of gas, which ran way over what they could sustainably supply with their own production, for example. That's a very different context to countries which in a way have a bigger choice. I was thinking about Ghana, for instance, as a newer oil and gas producer, sort of relatively small, but it's been a growing part of the economy, and it has, there's big plans for using the gas domestically for energy and some success in getting that gas into the power sector. But going forward, Ghana expects to use a lot more gas to fulfill its NDC commitments, for example, by using gas to push fuel oil out of the energy mix. And it's, the country's highly dependent on petroleum products, and most of those, I think about 95% maybe of those products are imported. So there's an obvious kind of desire to use more domestic production domestically, and yet there's a potential conflict given the very fast falling price of renewable energy, efficiency options, new materials and storage over the last few years. So there's a bit of a conundrum there around how to develop the domestic sector and the kind of investment, the kind of support that that countries will get for developing their domestic power and energy sector, given the shift, as I was mentioning, in MDB finance and investment. So and then for some of the smaller countries there's a few countries with smaller population but relatively large reserves. There's some new, there's new discoveries for Senegal, Mauritania, Guyana, for example, where there's high expectations of the benefits from fossil fuel production, and yet there's less, I guess, certainty around what those markets are going to bring in future. So there's a real need, there's a real need for all countries to have a strong focus on scenarios and building policies that are robust to different price scenarios, and even worst case, if you call it worst case scenarios for the future. There's also a question, for a country like Guyana, whose electricity demand has been growing very fast, and a desire to use some of that production to fulfill that electricity demand rather than importing it. How does that sit alongside the commitment of Guyana to use 100% renewables by 2025, for example, and the kind of climate finance that they might be able to receive to achieve that goal. So there's some real dilemmas in there. And of course, there is a possibility for those newer producers in using revenues to build a sustainable economy, to push into green growth, but then it requires really, really strong leadership and strong management over those revenues. And some of the pitfalls historically of using sovereign wealth funds are well illustrated, for example, or heritage funds or whatever. So I mean, I think I'll just end with sort of three key considerations, which are probably important for all producer countries, but they'll play out differently in different contexts. My colleague and I wrote a paper called Carbon Risks and Resilience a few years ago, and we recommended 3 areas really for producer countries in terms of building capacity and making key and policy considerations. One is developing carbon competencies in key areas of economic governance. So assessing the implications of the energy transition for domestic fiscal stability and the time frame for diversification. So it's really a job at the highest level in central banks, ministries of finance, ministries of planning. Second, designing energy industrial policy to incentivize transition. So to really understand fully the needs and the options for the energy sector, given new technologies, new practices that could be adopted. You know, the mix of decentralized and centralized options, for example, and the opportunities to price fuels and other energy products in the right way to incentivize the move to a cleaner energy mix. And then finally, preparing the fossil fuel sector for transition. And this is incredibly important. So within the sector itself, the ministries of energy and power, the upstream regulators, the NOCs, they may need changes in their mandate, and they may need stronger incentives to help manage carbon and methane emissions. So building capacity to procure clean technologies for the sector, monitoring and managing and hopefully bringing down methane and carbon emissions in the sector. And then for producers that have not, or prospective producers, trying to set the regulation right so that those capacities will be built in future. And then the potential to apply carbon pricing to analysis and decision making. I think that's an interesting one. I mean, Mexico and South Africa have both gone ahead with carbon taxation, and it's really helped them to understand their emissions, created an extra source of revenue for government, and helped them to get the data that they need to manage the sector. And there's a lot of, there's an increasing amount of help out there for countries right now to include targets on emissions reductions within the sector, within their NDC under the Paris Agreement. So yeah, I'll stop there. I hope I haven't gone on too long.
Gleda, that was an excellent review of multiple development path options, key challenges, and overall a pretty optimistic view of some of the outlook for these countries, with some pathways to manage that transition. So I want to come back to a bunch of issues, but I'll leave it for just a minute to hear what everyone else has to say, so I don't prevent them from saying it after. So Diego, I want to turn to you. Now, you're from Colombia, as I mentioned, a mature producer with a declining resource base. You've discovered large shale deposits. They've faced some domestic opposition. You also have a very ambitious policy on climate. So how do you reconcile those sometimes conflicting or opposing policy inputs, and how would you describe Colombia's policy today?
Thank you, Valerie. Hi, everyone. No, but in Colombia, to understand the national situation, we should know that Colombia has a fundamental asymmetrical condition. Namely, Colombia produced the 0 at 6% of the world greenhouse gas, but it is highly threatened by climate change. There is a similar situation in the oil and gas production industry. It produced the 6% of the emission in Colombia, but it must adapt to the new market and climate policy condition in order to stay competitive. Yes. In this order, we are working in two scenarios. The first, the medium term, of objectives for the industry to continue with the same level of production while reducing the greenhouse gas emission for that we are boosting emission. We are boosting improvements in energy efficiency, and we are working in a fugitive emission management. Yes, this is sector are very important to reduce the gas for oil and gas sector. All this with the propose of taking better advantage of fossil resource and achieve the established commitments in our NDC. The second scenario is the long term. We are working, or we are developing the net zero strategy in the energy and mining sector. We are the companies where the companies in this industry will be able to diversify their business with the new technologies and new service. For example, the energy. For example, in this context, the biggest company in Colombia of oil and gas sector, Ecopetrol, have a goal to will be a net zero or carbon neutral in 2030, in 2050. These companies have a big idea or a big visions to change a company of the energy sector. Yes, currently we are seeing that the companies of the oil and gas sector have the idea to change in energy companies. Yes, not only in gas and hydrocarbons, same or two working in energy and in other sectors of the Colombia. For example, Ecopetrol, they will want buy a company of the transmission of the electrical sector. Yes, this vision will be more big in other service. In this context, to finish, I think that the currently Colombia's policies are very ambitious, but are very hopeful because the sector are investment in new technologies. For example, the Colombians will have in the next years 3,000 of the megawatts of the renewables energy in this matrix. Maybe is a 25% of the oil matrix sector in Colombia. It's very important because currently only the 3% of the energy matrix in Colombia is from renewable resource. Yes, this is the principal ideas, and maybe continue.
Sorry, thank you, Diego. I think you've pointed out an important driver for adaptation to climate change and the energy transition that comes from the national reality related to being a frontline climate impact. You know, that if your country is expected to have negative impacts from climate, it does also create a strong policy driver for adjusting the course, as I said in the beginning. And it's not only coming from the outside, that pressure, certainly. So Espen, I wanted to turn to you and ask you, so you're with the Norwegian Petroleum Directorate, so the Petroleum Authority of Norway. How does climate change affect your decision-making when in the Norwegian shelf, you're examining the potential returns from projects? You know, how do you incorporate climate risk into that assessment of projects? And maybe you could tell us also a bit about what tools you use in that risk assessment and risk mitigation.
Yes, thank you, Valerie. I can do that. I was thinking I'd quickly set sort of the stage for how we look at climate risk on the Norwegian shelf, and then I'll skip to hopefully a couple of examples just to sort of dive into more of the details. So first of all, of course, the petroleum industry plays a vital role in the Norwegian economy. The oil and gas sector is our biggest sector in terms of value added, government revenues, investments, and export value. Production started back in the early 70s. The status today is that about half of, or 48% of the estimated recoverable resources have been produced and sold. An overall principle of for Norway's management of petroleum resources is that it should maximize value added for society. We also have a sort of division of roles. The government sets the framework conditions, but it is the oil companies that explore, invest, develop, and produce the petroleum and pay taxes. So government revenues from petroleum activities are transferred to the government pension fund global. And under the politically agreed fiscal rule, transfers can be made to the fiscal budget from the fund to finance important public goods without drawing on the fund's capital. Also, to give sort of as a background for the examples, a few words on our petroleum tax system. So it is a system based on the rules of for ordinary company taxation, but because of the extraordinary returns on production of petroleum resources, the oil companies are subject to an additional special tax. The ordinary company tax rate is 22%, and the special tax rate is 56%, which gives a marginal tax rate of 78%. The system is intended to be neutral so that an investment project that is profitable for an investor before tax is also profitable after tax. And this ensures a substantial part of the revenues for the Norwegian society, and at the same time encourages companies to carry out all profitable projects. So looking ahead, sort of in this climate policies setting, Norway will face both new and known challenges in the coming years. We have an aging population. There will be fewer economically active people behind every retired person. Government expenditure will increase without the matching increase in revenues. And at the same time, the green shift or the green transformation will be implemented. The consequences of climate policies and the technological development during the transformation to low emission societies presents risk to the Norwegian economy, as it can result in lower expected value for our petroleum resources. The impact of tighter climate policies on oil and gas prices is therefore of interest to investigate. And sort of the measure taken on the aggregate level is a white paper called the Long-Term Perspectives on the Norwegian Economy, presented by the Ministry of Finance this spring. In that white paper, the Norwegian government presented stress tests for both the petroleum sector, national wealth, and public finances. And this long-term perspective is a regular white paper that normally comes out every 4th year. The most recent evaluation there is that for the petroleum sector, the main conclusion is that Norwegian petroleum activities are, to a large degree, competitive under oil and gas price trajectories in accordance with the Paris Agreement. That said, there is uncertainty both with respect to the future production of Norwegian petroleum resources because of geological risk, etc., and the effect of climate targets on oil and gas prices. The established policy measure or the key policy measures for the Norwegian government's climate policy are focused on consistent emission pricing in the form of greenhouse gas taxes and participation in the EU emissions trading scheme. Petroleum activities on the Norwegian shelf are part of the EU ETS system, and also since 1991 have been subject to a carbon tax at the national level. Emissions are well documented. The combination of a carbon tax and the ETS, EU ETS, means that companies on the Norwegian shelf today pay 70 to 80 euros per ton for their emissions. So that's sort of setting the background. And then Marisol, if you can skip back to the slide before. Yeah, thank you so much. Just to dive into a couple of sort of points. This slide shows the discounted cash flow profile for recent field development on the Norwegian shelf. It illustrates the distinct phases of a field life cycle. A development phase with investments initially, a production phase, and a decommissioning phase. Production and the discounted cash flow will typically have a short plateau followed by a long tail. This project has a discounted payback period of 7 years, indicated by the red dotted vertical line. Such a cash flow profile is quite common for oil development projects mature to final investment decision on the Norwegian shelf. On average, the payback period is 5 to 6 years from investment decision. We've also assessed that 25% reduction in oil and gas prices would prolong the payback period to 7 to 8 years. So I want to make 2 short points on this. First, it can be argued that 7 years into the future following an investment decision is not that far ahead. By that time, a project will have adequate 7% real return on investment, the hurdle rate set for public investments on petroleum. Subsequent revenue is more a question of how profitable. The second point I want to make is that tax systems are important for risk distribution between companies and society. So I indicated a orange company share line that shows a neutral tax system where the company covers 1/5 of the cost and reaps 1/5 of the revenue. A non-neutral system could alter risk distribution between the government and companies. A higher or lower required rate of return will also influence investment decisions. And then, Marisol, please, the next one. Just a final point. In parallel with the white paper on long-term perspectives, our government this spring presented its climate action plan for all sectors of the Norwegian economy, both inside and outside the EU ETS system. The climate action plan includes a proposal to gradually increase CO2 costs up to 2,000 Norwegian 2020 kroners per ton in 2030, which is approximately 200 euros per ton. For oil and gas fields, and that is indicated on the left, a possible trajectory. Just moving to the right part of the slide. For oil and gas fields with CO2 emissions, this will increase operating costs. Increased operating costs can influence unsanctioned projects such as infill wells, tie-ins with additional resources, and the optimal shutdown for an installation. However, for fields with robust profitability and a short tail, an increase in CO2 costs will only have limited influence. For projects such as field life extension projects, possibly combined with tying of third-party resources and increased CO2 costs can to a larger degree influence decisions. And this particularly applies to situations with moderate cash flows, both for the host field and possible tie-in projects. Increased CO2 costs may then mean that a tie-in project will be abandoned, that the basis for further production from the host field is eroded and shutdown accelerated, and furthermore, that additional tie-in projects further away in future may not be realized and may not utilize the existing infrastructure. So that was sort of just to, there is a system of climate risk assessment on the aggregate level, and it trickles down to the individual projects, the non-sanctioned projects, and also the existing fields. And I just tried to give you sort of an insight into a couple of the points or the aspects we look at.
Thanks a lot, Espen. That was really interesting. And certainly this is something that we've discussed in the New Producers Group, is the importance of factoring in carbon pricing in making assessments on future revenues and the viability or the vulnerability of projects. So it's really interesting to hear you sort of lay out the thinking here. So Patrick, I want to turn to you and focus a little on national oil companies. There's such an important part of the effort to bring countries, to get countries transitioning towards a more decarbonized future, but their role in this regard isn't so clear. It would be interesting to hear your views on what would be an optimal role for NOCs in preparing their countries for the transition, or developing their niche in what they do best, or what they did best in the past. So it would also be great if you could weave in a bit of comments on what governments should look out for when they oversee their NOCs, because you just published some really interesting research on those risks called risky bets. And so, the risks that they take on as NOCs obviously have implications for public funding and public funds. So happy to hear your comments on that.
Great. Thank you so much, Valerie, and thanks to UNEP and NORAD and the other organizers for the chance to be on this really fascinating panel. To start, in response to your question, Valerie, I think you hit on something really critical as a starting point, which is that national oil companies are not sort of some peripheral actor in the pathway of resource rich countries of oil and gas producers, nor in the global fight against climate change. They are absolutely central, and that's why we've been trying to think as much as we can and to work with our partners in various countries on what NOC's pathways look like, right? We know national oil companies produce more than half of all oil and gas in the world, that they are responsible for almost half of global investment in the oil and gas upstream, but they're also really central in their own economies. And that's what I want to focus on today, is that we know, and as Gleda mentioned at the outset, the oil sector and national oil companies look very different in different kinds of countries, right? Some are operating a huge share of production themselves, are incredibly mature companies running huge operations. Others, in particular, in a lot of new producers, are smaller and play a role principally as overseers of the sector, or as the entity responsible for the share of selling the share of state oil. But nonetheless, in all of these cases, the NOC tends to play a really central role in the way that the country manages the oil and gas sector, and more broadly speaking, in the economy overall. So there's lots of countries where the NOC is the biggest single collector of public revenue in the country, and one of, if not the biggest spender of public revenue. And as such, they have a really important role in thinking about and in impacting what the economic future of their countries will look like. I'm going to focus on three different roles that the NOC can play and that governments should be thinking about as they're managing their NOCs, and they pick up on things that various speakers have said. The first is the role for NOCs in managing and hopefully reducing the carbon intensity of production itself, right? So NOCs, again, depending on the country, are either making a lot of operational decisions on their own, or they are playing a role as part of consortia with private partners in the management of oil and gas. And as both Gleda and Espen have noted in their remarks, the carbon intensity of the country's own production will have a huge impact on the climate footprint of oil and gas production, but also on the economics of the future of what oil and gas production and revenues might look like. So as countries face the prospects of more and more consumer countries or consumer jurisdictions implementing carbon taxes or carbon border adjustments, NOCs have to, and some NOCs really are, thinking more and more about how they can reduce the carbon intensity of the production that they're involved in, eliminating venting and flaring, making project decisions that take carbon intensity and potential Scope 1 and Scope 2 emissions into account at the level of investment decision. And to a large extent, this is a cross-government decision on how to set regulations and rules, but the NOC has a really strategic role in actually implementing the goals of reducing the intensity of production and thinking about and planning around what that future path might look like. So that's one. The second relates to the role that NOCs play in managing financial and economic risk. As I say, de facto in many places, the NOC is one of the most important actors in the public financial management system, but we don't often think of them as such. And I think it's important for governments to think more and more about the expenditure of their national oil companies and how it connects with a broader set of economic plans. The paper that you mentioned, Valerie, Risky Bet, is something that my organization, the NRGI, just came out with a couple of months ago. And we looked at the future investment profiles of national oil companies worldwide and found that using industry data, globally NOCs are slated to spend up to $2 trillion in CapEx in the upstream over the next 10 years, of which around 400 billion is in projects that only break even if the world blows past the Paris Agreement. In other words, they have break-even prices that are above the price that would need to inhere in the global marketplace if we got the kinds of consumption reductions that we need in order to stay within the 1.5 degree goal. So this has a huge implication for producer countries, right? These are billions of dollars in public revenue that risk being put into projects today with the idea that, as Espen notes, they will pay back over a period of time, in some cases 7 years, in other countries 10, 15 years. And if the market shifts away from what's needed for those projects to be viable, there's a risk of a real double whammy, right? Public money going into new oil and gas projects, and that public money not generating a return on investment that justifies its expenditure. So this is in some sense a challenge to the traditional model that a lot of NOCs have used, right? The justification has always been investing public money today in order to generate a return when those projects pay off in the future. Now, NOCs have always had a really mixed performance, even in boom times for the oil and gas industry. Some have generated incredible returns on public investment. Others have generated terrible returns on public investment. But today, as global markets shift, the risks and the uncertainties around those investments are changing and growing. And so it's time, we think, for NOCs, but also for their governments to think about the model of investing in these kinds of high cost projects today, as opposed to an alternative of reorienting some share, far from all of it, but some share of that public revenue to expenditure that can actually help finance and fund the diversification of the country today. And then the third risk I want to talk about is, or the third role I want to talk about is the potential role for national oil companies in economic adaptation. So some NOCs, as Gleda mentioned, are starting to invest more and more, and as Diego referenced as well in the case of Ecopetrol, are starting to invest in renewable energy projects. Other NOCs are starting to invest in other pieces of the economy with the goal of mobilizing the capital and the expertise that these companies control as part of a national investment in energy diversification and potentially in broader economic diversification. Now, there's big questions around this, right? Some NOCs are really well placed to make this kind of pivot. In other cases, there's a chance that there's a conflict of interest between the kind of core traditional oil and gas business and these new businesses that they might be moving into. And so the answers are far from easy, but I think it's important for governments and their NOCs to start thinking about what the role of these companies might be. So to sum up, we know that it's impossible for NOCs and it would not make sense for producer governments, largely speaking, to shift out of the oil and gas sector altogether today. NOCs will continue to play a role in earning financial revenues that can be used to invest in the country's development. But there are certain things that NOCs can do to start to play a more resilient role, or to start to think more strategically about how they play a role in economic resilience long term. I'm just going to go through them briefly, and hopefully we'll have time in the Q&A. One is across the portfolio, doing risk assessment of projects, which ones are viable under which kinds of energy transition scenarios, how expensive they are, and what that means for investment decisions and the riskiness of these investment decisions. Two, focusing heavily on efficiency in projects that are ongoing, because even oil and gas projects that are viable over the long term will likely see lower returns and will find themselves increasingly strained. And so efficiency among NOCs in order to maximize the amount of revenue that they're distributing to their countries is more important than ever. There's less wiggle room than there used to be in the sector. Third, as I said, re-examining the NOC's role in the social contract, whether that means investing in new areas. In some cases, that means narrowing the NOC's scope, right? And focusing on revenue maximization rather than big investments, right? And so I think there's a big question that needs to be asked of what is the role for these companies moving forward? They will all have some role, but in some places, I think it's important to have the option of that role being narrower than it has been traditionally conceived. And then finally, investment in public accountability and in participating in and stimulating real conversations about what the company is doing, how its success should be assessed, and the role that it's playing in public life and public financial management more broadly. So I'll stop there, really looking forward to the discussion. Thanks.
Thanks, Patrick. That really, I think that gives a great overview of the range of realities of NOCs and the different risks they encounter. And I think it stands in pretty, interesting contrast to what we know of international oil companies, the private companies, and how they're managing this new sort of decision-making environment. And that one is better known. So I think it's really useful to have that review. So we're getting some really interesting questions from the participants, and several of them are related to, do we see effective progress against, some of the measures that have already been identified as important? For example, reducing flaring, a question around the fact that operators are not yet stopping flaring. How would you tackle this problem? Or another question on how do you incentivize oil and gas producing economies to invest in renewables? And then another on capacity building. Uganda is the case. It's at a disadvantage to implement and integrate these initiatives for a low carbon future. Are there any other support and funding opportunities to build that capacity in developing countries like Uganda? So these questions kind of are interesting because it's, what would be the levers to really unblock or make real progress at the NOC level, at the IOC level, the government level, in helping, especially developing producers move towards the transition. And I'll just add one suggestion also is that, Gleda, you mentioned the development, multilateral development banks. Both they and development agencies from the OECD have been withdrawing from oil and gas capacity building or investing in oil and gas, with the exception of, notable exception of the Norwegians. Should they be doing more? Could they be doing something valuable to help producer countries put in place technologies, regulations, institutions, incentives for investors that would help manage flaring, introduce carbon taxing, et cetera, and different measures? So I'd be interested to hear, go around the panel and hear your thoughts on that. I might start with you, Gleda, since you had already formulated some thinking on that.
Okay. Yeah, thanks, Valerie. Can you hear me okay without my headphones?
Yeah.
Good, good, because they were hurting a bit. Yeah, so I think that the policies are very much in formation on the MDB side at the moment. So you can expect those to come, in the next year or two. And they will definitely, in terms of how the funding flows towards assisting countries with their sustainable transition model, will very much depend on the countries themselves, having clarity at the planning level and willingness to design or co-design that transition pathway. Of course, nobody has this perfect model for transition. There are a lot of new issues in the mix here. So it's clear that some of the MDBs are very interested in the issues of just transition, for instance. How do you find an equitable pathway that delivers development, that delivers to the communities that might lose out as you phase down your oil and gas sector? I think there'll be a lot more movement on that edge. In terms of helping the sector to adjust, I know about the great work that UNEP and NORAD are doing. I think there's a few other organizations, of course. NRGI is one, and our own new producers group, who are helping countries to think through these issues of policy alignment, how to align the policy for their sector with the wider NDC commitments and their sustainable energy access and development programs. So I think that it's a growing area. No one's quite there yet, and I would love to hear from other people in the audience. Actually, maybe they've got some comments on this, if they can use comments, because I'm sure they're more knowledgeable on what help is out there. But definitely, we know, for instance, the European Development Bank for Reconstruction and Development, the EBRD, did a pilot a few years ago with Kazakhstan and Egypt, which the report is available online, where they worked with the ministries of finance, looking at different scenarios for oil and gas price, and what that would do to the fiscal and current account balances in those countries, and how they could prepare, looking quite a few years ahead. They were using IEA numbers. Some people could say those numbers, say $60 per barrel oil, are very conservative. We should be looking at a range of scenarios, and given what happened in the last year, I think the whole context for prices changed, and we do expect volatility in future, and then a long-term decline, and so no one knows exactly when that's going to happen. So the emphasis really should be on preparing ministries of finance, planning, and central banks for managing that volatility and flexibility in planning. And you can use several fiscal instruments, fiscal reforms, plus addressing the energy sector to try and mediate the effect that that's going to have on your economy.
Mm-hmm. Thank you. Diego, from Colombia's perspective, do you feel that, what do you think, from your experience, would be levers that would really help bring greater progress towards reduction of emissions or different climate targets?
Okay, Marcel, this is a good question. I think that in Colombia, there are different instruments, different tools to generate this change. I want to talk about maybe around the three instruments. The first instrument, and the most important for my work, is the plan of climate change of the mining and energy sector. This was the first plan in Colombia, where the different industries push or put a goal about the reduction emission. For example, currently our goal is reduce 22 million of tons to 2030 emission or in all sectors. For example, we have other experience in this. Currently, we are working in develop a normative of the gas a fugitive emission. Yes, a flaring and management of different fugitive emission on industrial gas and oil and gas. And the third instrument maybe that we are working is the roadmap of the hydrogen in Colombia, where our expect is that in the future the hydrogen will be a most important energy in Colombia. For example, other experience in Colombia is the law of the mobility sustainable. For example, this law made that the Colombia was the principal of the leader in the ration of the sale of the electrical vehicles the last years. And yes, this is the most important for, I know there are other important experiences for us, is the development of the different normative to improve or to integrate the renewable energy in Colombia. Yes, this is the most important policy that in the last years, this policy made that the Colombia was the leader in the region in the renewable energy, and for that, national United Nation. I'm sorry. Colombia, currently Colombia is the leader in the high dialogue of the National United for countries that leader the transition energy in the world. Maybe to finish, is that we are working in 5 instruments, 5 tools: policy in climate change, policy in transition energy to improve the renewable energy, policy in law in sustainable mobility, regulation in fugitive emissions, and I forget the last, but yes, this is the principal instrument and experience that in Colombia have in this moment currently.
Thanks, Diego. So to Gleda's point that clarity at the national level is an important lever, Colombia has that, and that's been a very supportive feature in getting you to where you are. Espen, do you want to take this this question?
Well, yeah, just sort of a combination to the response to the questions and some general points. Of course, I can understand the complexity of this for emerging petroleum producers. We do not currently have national oil companies in Norway. Equinor used to be a national oil company, but is now an IOC, so it sort of answers to the capital markets, etc. Of course, the Norwegian state has an ownership share in it, but it is as any other owner and needs to sort of adhere to the commercial framework as an owner. I would say NOC, IOC, whatever, it is important to hold the companies accountable and responsible for their decisions when it comes to invest, develop, produce, etc. In setting up a system, I would strongly look to how you can correct for externalities in economic terms, and flaring is one of those externalities. Our experience with the petroleum tax from the early 1990s is that will be effective and reduce greenhouse gas emissions. Companies will sort of follow the incentives you give them. The other point, which I sort of touched upon in my presentation, is the question of risk distribution. You have different types of regimes, production sharing agreements, etc. But I would, with sort of the climate issues, try to assure myself that I would not end up in a situation where the companies get a return rate on their investment initially, and then the countries sort of is stuck with the income on at the later stage. I would have try to have symmetry in that. When we try to include flaring, those initiatives in our capacity building in the Oil for Development program. I mean, it's part of the framework for how we do it in Norway, and that's sort of what we try to explain when we go abroad and talk about the Norwegian system. There was one final point on sort of how to get the NOCs to invest in renewables. Equinor is a big company in Norway. It does invest in renewables, but that is based on what they see for themselves as optimal. It is not sort of decided by the government, and that would be inconsistent with the way we organize activities here in Norway. That is decisions up to the companies to take, and not sort of decided by the government.
Thanks. Those are really several specific levers for progress there that were highlighted. Patrick, do you want to think about some of those levers for progress?
Well, yeah, just to come in on one part of your question, Valerie, I think it's interesting. I think as governments think about their interaction with the international community, and sort of vice versa, as the international community thinks about their interactions with oil rich countries, I think it's really important that we, and to build on something that Gleda said, I think it's really important that, one, from the producer country perspective, that there's a little bit of a, kind of an awareness of kind of the reality that oil and gas projects are becoming disfavored in the international community, obviously because of the the critical importance of fighting climate change, and that the producer countries need to take that reality into account as they plan their international relations, and as they plan the way in which they are organizing themselves and talking about kind of transition and their approach to it. But I think the flip side is also really important as well. And to build on something that Gleda said, I think there's an important distinction to be made between financial support to oil and gas projects themselves, which lots of development institutions and banks are moving, and private financiers are moving away from, and the need to invest to support countries in their own transition plans. And that means energy transition, but also economic transition as well. And that, I think there's a real risk that international actors sort of, try to put their own blinders on and say, okay, if a country is today dependent on oil and gas, they're on their own because we can't touch that at all. From one perspective, that impedes obviously the fight against climate change, right? Because it's not providing the kind of support that countries can really use in order to decarbonize and in order to make more strategic decisions about their own public investments. But secondly, and critically importantly, it's relegating, or it doesn't provide support for countries to help promote development that's necessary for, we're talking about hundreds of millions of people worldwide. And so I think that it's really important, and the role that UNEP is playing is really valuable, to differentiate between investment in oil and gas projects and investment in supporting countries that have been dependent to build more resilient economies, diversify, and plan for their own transitions. And so, one of the things that I think it's valuable for leaders from the countries themselves, but also those of us who are involved in these issues to be pushing, is that distinction and the critical importance of investing at a national level and at an international level in transition planning.
Thanks. That's a really important distinction, investing in supporting the resilience of these countries and not actually investing in the sector from the outside. That's really important. We have some questions that are interesting, which around sort of the low-hanging fruit. One question is, what are the probable best low carbon technologies that third world countries can invest in to reduce carbon emissions? And then also, a question asking whether CCS, carbon capture and storage, is a valuable opportunity. Is it going to be, can it be applied in developing countries, or is it something that isn't that low-hanging fruit for them? And I think also some questions around offsetting, having maybe this is part of that low-hanging fruit category, but, planting forests, different nature-based offsets in addition to carbon capture and storage. What kind of measures should countries be looking at? Maybe we'll do a quick round if anybody wants to take this kind of quickly, just to give some ideas of what would be valuable, as much for the development banks and development agencies to support countries with, and valuable focus for the countries themselves. Gleda, do you want to have a go at that?
I wanted to say just something about methane leakage, because that's a big issue for many countries during the gas processing, transmission, and the upstream production facilities. There's now a number of initiatives to help countries to monitor and assess, the levels of methane leakage that they have. I remember seeing some presented by UNEP, so I think that's the place to go for more information on that. But that seems like a low-hanging fruit, to plug some of those gaps and really reduce the methane emissions, which is a much more potent climate forcer actually in the short term than CO2. And there's some upcoming initiatives. I mean, there's already satellites that focus on methane. There's some more, I think, that will be launched in the near future that will give an even more detailed picture. And if you think about it, with the growing knowledge, the growing big data on emissions, both carbon and methane, that will start to factor into the oil and the oil, the oil cost that we talked about before. You'll start having a more transparent picture of the high emissions intensive products. So it's something for countries to maybe make an early start on before that kind of transparency damages their market. CCS, I'm pretty skeptical on, to be honest, apart from countries that can really do it well and afford it. I mean, Norway, Saudi Arabia, UAE, UK, of course, they should do it, and they should do it as fast as possible, and they've got the capacity to do it. But so far, it's really only been commercially possible, either where it's for enhanced oil recovery, so it's actually being used to help push more oil out of the ground, or where there's a high carbon tax, very high carbon tax. And there's probably only about 19 projects around the world so far. It needs to move a lot faster to get us where we want to be in terms of the Paris Agreement, and yet for developing countries with less capacity and less experience in the area, it's a big undertaking. And it requires, the right regulation. It requires the technical ability, and it really should be the onus should be on the investing companies to develop that, if it's geologically possible, if they are planning to produce in those regions. CCS will add to the cost of the oil because it will entail an energy penalty, essentially. If you apply it to a gas-fired or oil-fired, coal-fired power plant as well. So in terms of the electricity sector, where you'd want to see it applied as quickly as possible, especially on coal and on gas too, it's I think countries are generally reluctant because of the extra cost that it will add, and again, it needs a high carbon price to really work, to really encourage companies to invest in it. Offsetting, I think I'll leave that for someone else, but because they will know more than me on that.
Thanks, Greta. Who else would like to take this question on low-hanging fruits? Espen, go ahead.
Okay, thank you. Well, just to sort of completely agree with Glada on the methane leakage and in general emissions on as a low-hanging fruit to address. So I agree with her on that. But of course, an important part of that is you need to measure and report the leakage, and that is an important part of the system, because you need to sort of get it right, and then that sets the basis for any taxes or any reduction. So that would be an important part of it. When it comes to CCS, it is. I mean, we have actually a big project, a full-scale CCS project going on in Norway these days, where an investment decision has been taken. But there's still some R&D work going on there and sort of proving the profitability of it. Of course, the big question and what makes it profitable or non-profit is the issue of a price on emissions. So if you see a CO2 price going up sort of on the scale that I showed was the political ambition, at least of Norway, then I think you could also see CCS as a commercial alternative. But of course, Glada has some good points on sort of the extra cost it will bring, but at least that's how we see it now. So we're slowly moving forward. Whether it's for everyone, I'm not sure. We are still in the early phase here. And when it comes to offsetting measures, I'm sorry, that's outside my area of competence.
Thanks, Espen. Diego, do you have a feeling on what were some of the low-hanging fruits in Colombia, or might be in future?
Yes, Valerie. I just want to say that we are seeing that it's very difficult to implement this new technology in Colombia in the next years, but it's really, really important and necessary start with the policy that encourage this technology. Currently, we are working in the policy that allowed or enable investigator research, different action of the series of the companies that allow in the future implement this technology. It's difficult, but the problem of climate change is big. It's important working in these new technologies. CCUS for Colombia, for our sector, is very important because we are working with, or we are seeing that is the only way that we are reach the net zero in 25. In the next, yes, this is the only thing that I want to say.
Thanks. Patrick, what do you think? Low-hanging fruit?
Yeah, just to add a different type of low-hanging fruit, which is, I mean, the other panelists are much more expert than me on the technological side. On the policy side, there's a low-hanging fruit that a lot of countries are starting to do, but we meet many people, many officials in countries where they haven't started to do that, which is just stress test all of the country's projects, currently operating projects and potential future projects, to gauge their economic viability under a variety of different scenarios around future oil prices, carbon taxation systems, and other mechanisms designed to help the country make more informed decisions about investment of state capital, but more broadly speaking, the fiscal regime and the governance of these projects. There is, because there's so much uncertainty, we've seen that in a lot of countries we're working, especially in new producers, there's a reluctance to sort of actually run the numbers and get a sense of what different scenarios might mean for development prospects. And I think that's really important, technically not very difficult to do at all, but potentially with a real impact on the sustainability of decision making moving forward. So that may only be a partial response to the question that the attendee intended, but that to me is, I think, one of the biggest things that's relatively straightforward to do that a lot of countries aren't doing yet.
Thanks. Yeah, it's not all technology, certainly. I mean, it seems, you know, that some of the words that keep coming up in this discussion are the price of CO2. You know, it's really having that. It just shapes the decision-making environment for companies, for governments, for development banks. It's just a critical part of this puzzle for thinking of progress on getting countries adapted or resilient to a more decarbonized system. And the other one is clarity in the policy signals. So clear policies, sending clear signals. So these are enablers and incentives, and it's the lever for that more integrated intragovernmental policy approach to these complex problems. I thought, so if you haven't noticed, I'm sort of wrapping up with my sort of concluding thoughts here. I think that it was quite interesting to hear also your thoughts on the levers for progress, because I think in a lot of the questions that we had from the audience, it showed that but we're in a developing context, we're an emerging producer, can we progress? Is this for us? And I think that you did really highlight a lot of interesting ones, of which, of course, that policy clarity, helping the Ministry of Finance and Ministry of Planning prepare, anticipate, as you just said, Patrick, stress test projects. And then I think the emissions, so going back to the emissions tax to avoid flaring, And then I really like the point on investing in this, in supporting these countries, building their resilience so that they can adapt to these, this changing system. There's much more to highlight, but I think I'll turn over to Marie-Sonne and say first, thank you so much to our panelists. This was really a fascinating discussion, and I look forward to the next 2 webinars.
Thank you very much, Valerie, for the moderation of a very complex discussion. And thank you for the panels for also helping us navigate through these kind of complex issues. And indeed, like for this first webinar, the starting point really is from a policy perspective, right? Because that is really the framework in which you know, like measures and concrete actions can be taken at the country level. So that's why we started on this webinar looking at the policy alignment in countries, and I think that has come out fairly strongly, especially also from the perspective of Colombia and Norway, and based on their experience. So I was like really happy to hear all of those issues come out, and indeed there were questions about, you know, these low-hanging you know, measures that countries can take, low carbon technologies. And in fact, so this is what I would like to then emphasize, is invite our audience on the platform attending this webinar to our next webinar. Let me see if I can generate this my slide to show the following webinars that will come up, which is in July 6th. And indeed, it will start to tackle some of these technologies. So, I mean, assuming that you have the policy and frameworks in place, then you can start to think about what are some of these low-hanging, low-carbon technologies that contribute to climate change mitigation in the upstream oil and gas production. And we have lined up speakers, invited speakers to this webinar, including from the IOGP, from Oil and Gas Company Association, which will be represented by their environment director. And I see that Wendy Brown is also attending this webinar, so she will actually be a speaker for our July webinar, focusing on carbon CCS, carbon capture and storage technologies. And then we have also invited carbon limits to speak on issues related to methane emissions reduction and also addressing flaring issues for this webinar. And we will also invite our UNEP colleagues from our energy branch to talk about some of the global initiatives related to methane emissions reduction. So I really would like to invite those of you who have attended this webinar to join our webinar coming up in July. And then in October, we will have also then a focused discussion on issues related to decommissioning of oil and gas fields and some of the best kind of environmental practices around that issue. So because these are some of the issues that will come up as oil and gas producing countries will transition and look at how to transition away out of their oil and gas fields, and what are some of those issues that you need to keep in mind. So with that, I will you know, come to a conclusion. Just to let you know that if you are interested in receiving a certificate for attending this webinar, there will be a survey that you will receive that we would invite you to fill in order to receive the certificate. So, you know, we have here I'll ask my colleague Chidima to upload the link to the survey, and you should also receive it, I think, at the end of the webinar. There will be a prompt for you to fill in the survey, which will then help generate a certificate for your attendance today. I also then would like to invite you to join our LinkedIn group on the Global Network on Environment and Oil and Gas. So it is just an exchange forum, an informal forum for exchanging information and you know, upcoming events, etc. So with that, I think I would like to then conclude and just say that we will upload this recorded webinar on our YouTube channel. So stay tuned. If you're on LinkedIn, then you will be able to see the link to the YouTube recording of this webinar. So again, on behalf of all of the co-organizers of this webinar, I thank you, the panel members, for their participation, and we hope to then see the rest of you who have attended this webinar in our next webinar in July. So thank you very much. Signing off.
Thank you.